There is no law anywhere that forces you to refinance after divorce. Not one. So if a deadline is staring at you and your ex has done nothing, you might be thinking you can just leave the mortgage alone and move on. And I get it, but there is something going on behind the scenes with that mortgage that most people never find out about until it costs them. And it is the reason skipping this quietly becomes one of the most expensive mistakes a divorced homeowner can make. The confusion starts with one simple mix-up between two documents you signed. You got the house in the settlement. Your name is on the decree. Maybe your ex even signed a quitclaim deed. A claim deed is just a document that transfers ownership of the property from one person to another. So when your ex signs it, they are handing you the house. Great, feels done. But the deed and the loan are two completely separate things. The deed says who owns the house. The loan says who promised the bank they would pay it back. Signing a quitclaim moves the ownership. It does absolutely nothing to the loan. Your ex can hand you the deed with one hand and still be legally tied to that mortgage with the other. And so can you. So, what does that actually mean for you day to day? As long as both names are on that mortgage, both of you are legally on the hook for it. It does not matter who was awarded the house in the decree. It does not matter who is actually writing the check every month. The bank still sees two people who both promise to pay, and it reports to both credit files until that loan is paid off or refinanced away. And here is the part that quietly works against you. Even when you are making every payment on time, that mortgage is still sitting on your ex's credit report as their debt, too. It counts against them when they try to buy their next place. And most exes find out about that about 6 months in and start pushing you really hard to refinance. Sometimes politely, sometimes through their attorney. That pressure is real, and you want to be the one driving the timeline, not reacting to a demand letter. Now, flip it the other way. If life goes sideways for you and a payment ever gets missed, it does not just hit your credit, it lands on your ex's credit too, for a house they do not own and do not live in. Now they have a real grievance against you on top of everything else because you just damaged their credit on a loan they were supposed to be released from. The only way to shut all of this down is to get their name off the loan. And the only way to do that is with a new loan in just your name. That right there is the problem. And it is why, even though no law requires a refinance, your divorce decree almost always does. The people who write these agreements know that the only way to truly separate two people from a joint mortgage is to remove one of them from the loan itself. A decree can order it. A quitclaim can transfer the house, but neither one actually takes a name off the loan. Only two things do that: a refinance or a loan assumption. So, what are those really? A refinance means you take out a brand new loan in your name only. That pays off the old joint one. The old mortgage with both names on it disappears. The new one has just you. And this is also usually how you handle the buyout, meaning the cash you owe your ex for their share of the equity in the house. You borrow enough to pay off the old loan and hand your ex their piece. all in one move. An assumption is different. That is where the existing loan stays in place, but you take it over solo and your ex gets released from it. Not every loan allows this, and it does not give you cash to fund a buyout. So for most people, the refinance is the real path forward. Now, I already know the fear sitting underneath all of this because I hear it constantly. You are worried you cannot qualify on your own now, one income instead of two. And on top of that, you lost the low rate you had. So the whole thing feels impossible. Stay with me for a second. The number that scared you off may have been run on the wrong loan entirely. And honestly, this next piece is the whole reason I made this video. When most people get quoted for a divorce buyout, they get quoted a cash out refinance. A cash out refinance is when you borrow against your equity and take money out. And those loans come with tighter limits on how much of your home's value you can borrow, and pricing that works against you. So you get a scary number and you assume that is your only option. But on the conventional side, a buyout tied to a divorce does not have to be treated as a cash out at all. Under the guidelines, when one owner is buying out the other because of a divorce, and you have both been on the title of that home for at least the last 12 months, it can be treated as a rate and term refinance instead. That is a completely different set of rules. It opens up how much of the home's value you can borrow, which matters enormously when you do not have a big pile of equity to work with. Same house, same buyout, a different loan, and suddenly the math that felt impossible starts to breathe. There is a catch buried in that 12-month rule, and it is exactly why I want to reach you before your divorce is final. To get treated as a rate and term refinance instead of a cash out, you have to have been on the title the whole 12 months before closing. So, if a well-meaning attorney quitclaims your ex off the house too early to tidy things up, you can accidentally kick yourself out of the better loan and back into a cash out territory with the tighter limits and the worse pricing that come with it. There are still paths if that already happened, including FHA financing that handles divorce and lets you borrow a higher percentage of the home's value. But the point is the order matters, and getting a mortgage person involved early can protect your options you did not know you had. One more thing worth putting to bed. That support income you're counting on, the alimony or child support, it can absolutely count towards qualifying you when it is documented the right way and expected to continue long enough. So the picture of you drowning on one income might not even be accurate once someone actually looks at your whole situation. This is exactly why I work these files the way I do. Before we ever talk about rate or run a single scenario, we start with where your settlement stands, who is on title, who has been paying, and what your actual buyout number is. That is the first step of what I call the clean break blueprint, treating you as a whole situation instead of just a file. Because a divorce is a settlement with a loan wrapped inside it, and it has to be handled in that order. So do me a favor, do not apply anywhere yet. Do not spend earnest money, and do not let the deadline in your decree push you into a panic move. Book a free strategy call with me using the link right below this video. Bring me where your decree stands and what you know about the house, and I will tell you straight whether you can qualify and which path actually keeps you in that home before you risk a single dollar. If this made even one piece of this feel less impossible, subscribe, because I break down this exact stuff for people going through it every week. And you should not have to figure this out alone.